Alright, moving into part 2 of the Chapter 5 presentation, starting on slide 21. We were talking about purchase discounts, and here you see 3 typical purchase discount terms. So you should understand what each of these is saying, starting with the first one on the left here, 2/10 N/30. What that means is that there's a 2% discount offered if you pay within 10 days. Otherwise, the net amount due is due within 30 days. For 1/10 EOM, which stands for end of month, you get a 1% discount if it's paid within the first 10 days of the next month. So you get 10 days after the end of the month, and you can get a 1% discount if you pay within that time. And the last one is N/10 end of month. So in this case, the net amount's due within the first 10 days of the next month. You're not getting any percentage discount. Excuse me. Of course, one of the most typical payment terms that I've seen is just the net 30 or N/30, which just means the balance is due within 30 days. And after that, you might start actually racking up some late charges. Excuse me. On to slide 22, recording the purchase of merchandise. So here's the example shown on page 235 of the text. And note how the discount was computed, the total balance due times the discount rate. Note again that the discount has no impact on the accounts payable balance and the amount debited when the payment is made, but it does impact the inventory account via a credit for the discount amount. Again, follow the logic of this entry, which reflects a reduction in the inventory cost and therefore a reduction in the asset based on the fact that we took the discount. Moving to slide 23, here's a journal entry if the discount was not taken. So note that the full amount credited to cash and that no adjustment is needed to the inventory account. On slide 24, this example is trying to show why it would make no sense to not take the discount offered even if the buyer had to borrow the money to do it. That's because a 2% discount offered over a 10-day period yields an annual rate that is much higher than the prevailing market rates. You'd explore that more in a finance type course than this one, so don't worry about having to do any fancy calculations to prove out whether a discount on merchandise makes sense to take or not in this class. On slide 25, this chart summarizes the activity in the inventory asset account during the period. Notice that the debits for the full purchase amount and the freight in charges paid, and the credits for the purchase return of $300 and the discount taken of $70, resulting in the final debit balance of $32.80. So all those pieces had an impact on our ending inventory balance. On slide 26, now we return to the sales side of things, remembering the revenue recognition principle that says that sales should be recorded in the period earned regardless of when cash changes hands. This is important as most merchandising concerns do a significant amount of their sales on credit versus in cash. As with purchases, sales should be recorded when the goods transfer from the seller to the buyer. And an invoice should support each sale, especially, of course, credit sales. On slide 27, here are the journal entries needed to record a sale. Note in the first entry that the debit may be either to cash or accounts receivable, or may be some of both, depending on the transaction, and the credit is to sales revenue, regardless. Then there is an associated entry debiting the cost of goods sold, which is an expense, and crediting inventory, an asset. Remember that this entry reduces assets and stockholders' equity, since expenses reduce net income and therefore retained earnings and stockholders' equity. Remember also that now that we're talking about the perpetual inventory system, so we're keeping running tabs on not only what's sold, but the cost of the goods that are sold and the inventory balance. And that's why that second entry is in there. On slide 28, note in the example shown on this slide and page 236 of the text, the sale is 100% on credit, and therefore the accounts receivable account, not cash, is debited. Note too that cost of goods sold and inventory are only debited and credited with the cost of the merchandise, not its selling price. So you need to be able to make that distinction if you're asked to make entries of this nature. This little story illustrates the importance of good accounting controls, such as tracking the volume of voided transactions, sales trends of low cost versus high cost goods, and so forth. And again, you might get into more of this type of thing if you take an auditing type course. On slide 30, sales returns and allowances are indeed the flip side of purchase returns and allowances. Now we are on the seller side of the table, getting goods returned to us that the customer claims are defective or not correct, or allowing the customer some discounted amount off the original price because of customer dissatisfaction with the product. Unlike the purchase returns and allowances, which go directly into the inventory account, at least with the perpetual system, sales returns and allowances are charged or debited to their own accounts, and in the same way accumulated depreciation is a contra asset account subtracted from property, plant, and equipment, items that are depreciated. Sales returns and allowances is a contra revenue account with a debit balance that is subtracted from gross sales. And you'll see that in the income statement presentation. As the slide explains, sales returns and allowances are kept separate from sales revenue for tracking and comparison purposes. So we have a consistent basis to measure our sales from period to period. On slide 31, so here is how the seller in our example would handle the return of items that he or she sold to the buyer. The buyer's purchase return of $300 would be a sales return to the seller. It would also reduce the amount owed by the buyer, that is, the accounts receivable amount is credited or reduced. At the same time, the returned goods would go back into the seller's inventory, necessitating an entry to debit inventory and credit or reduce the cost of goods sold for the cost of the items again, not the selling price. On slide 32, now if the returned goods were defective and worth only $50 in scrap value, the entries would be as shown on this slide. The difference being that the debit to inventory and credit to cost of goods sold would be smaller based on the scrap value versus the original cost. So on slide 33, a review question. Only a perpetual inventory system does what the question is asking about. That is, the cost of goods sold is determined and recorded each time a sale occurs. So again, this does not happen with the periodic inventory system. On slide 34, significant sales returns can have significant implications for the company's bottom line as well as revenue recognition. As noted on page 276, if significant sales returns are anticipated, they should be estimated and recorded at period end to provide as accurate a measure of the true revenues earned as possible in accordance with the revenue recognition principle. On slide 35, sales discounts are also the flip side of a purchase discount and are accounted for using another contra revenue account with a debit balance to offset total sales revenue, as shown in the chart that is also on page 239 of the text. On slide 36, here's the seller's entry to record the receipt of cash payment that recognizes the sales discount of 2% taken. Therefore, only $34.30 in cash was received and debited, while the accounts receivable is credited for the entire original sales amount of $3,500. The sales discount of $70 is a debit entry that will offset total sales in the income statement. Again, understand why accounts receivable was credited for the entire amount, because that still was the original balance of that customer's account and needed to be written off in its entirety when the bill was paid. Slide 37, the single-step income statement is what we've been using thus far in this course. Because of the new items introduced in this chapter, we need to take another look at the format of the income statement. As the slide indicates, there are two reasons for using the single step forward. format. The company doesn't realize any type of profit under total revenues and until total revenues exceed total expenses, and the format is simpler and easier to read. On slide 38, in this example, it's shown that a single-step income statement format can work for a merchandising concern, but this does not necessarily show the level of detail desired for such a business. On slide 39, the multiple-step income statement shows more detail regarding the pieces that make up the bottom line net income. For instance, the gross profit, which is net sales minus cost of goods sold. Then the income from operations, which is the gross profit minus operating expenses. And then, finally, the bottom line net income. On slide 40, in the Walmart example shown on page 240, notice the key line items as noted on the slide and their placement. Gross profit, income from operations, and net income. Note how these amounts can be compared between periods as well to see how the relationships to one another are holding or not. In other words, is gross profit still as high a percentage of net sales? Is income from operations or is net income still as high a percentage of net sales, and so forth? The questions can be endless, but should focus on what's relevant for management decision makers. And review question on slide 41. Of the responses shown for this question, only D does not fit in the multiple step income statement. Investing activities is a statement of cash flows section, not related to the income statement at all. On slide 42, note that in this example on sales revenues, gross sales are presented first, then the sales returns and allowances, and the sales discounts, which again are contra sales accounts. They're subtracted with a subtotal of those two accounts provided as a subtract number. Therefore, the net sales are gross sales less the returns and allowances and discounts. And that's where the term net sales comes into play. Slide 43, the next step in the presentation is to present the cost of goods sold. And when that is subtracted from the net sales, the result is the gross profit. That is, the profit made strictly on the goods sold before subtracting other operating expenses. On slide 44, so next we present the operating expenses: salaries and wages, utilities, advertising, depreciation, insurance, freight, and so forth. The expenses that help keep the business going besides the merchandise itself. Subtracting these expenses from gross profit then yields the income from operations. And on slide 45, finally, we have the non-operating activities that need to be recognized, although they are unrelated to the company's main line of operations. These are usually rather unique items, some of which occur most every period, such as interest revenue and expenses, and some which are infrequent, such as losses or gains on the sale of a property, plant, and equipment item that's no longer used in the business, as an example. And with that, we'll wrap up the second part of the presentation.